It's time now for the big picture. It's time to welcome in Liz Ann Sonders, Chief Investment Strategist over at Charles Schwab. Thank you so much for joining us today, Liz Ann. It's such an important day to have you on, really, as we are just really in the thick of everything right now. So let's just sort of take a step back and look at sort of what we got in the last sort of 24 hours. I mean, the market's got their rate cut, but there's a big question mark over December. The market's also got their trade truce, but there's a question mark over implementation. They also got the commitment to CapEx, but there still seems to be questions around ROI. Is that sort of the right way to characterize what we're seeing in the reaction today?
I think it's a brilliant way to characterize what we're seeing. Yesterday was interesting. Sam, as you know, for us, it was not a surprise that we got what one might define as a hawkish cut. We felt that maybe the market had gotten a little bit ahead of itself in assuming a series of rate cuts, given the fact that we've got inflation still above target and actually not getting a lot of government-issued data, but what data we can get about the labor market suggests a softening there too. So that part of it didn't surprise us, but you saw sort of knee-jerk reaction. I mean, the NASDAQ had a complete round trip, immediate sell-off after the Fed made their announcement, and then a rally back. And then we had, of course, the post-close earnings reports, and today is sort of a tale of three different stocks, three of the Mag 7 having reported very different trajectories. And I think that does point out that there's dispersion now happening even within small cohorts. And I think you're right about the China-US truce. There's still so much ahead of us in terms of tensions between the two countries. And I'm not sure what was established really alleviates some concerns. It does lower the temperature right now. It frees back up access to rare earths and provides soybean farmers with access to China's market, but it's certainly not an answer to all the questions.
So what's driving this market right now? I mean, it seemed to be down to three things. I mean, the earnings expectations, and so far we've heard from around half of the S&P 500, over 80% have actually beat expectations, which seems pretty good. But then you've also got these sort of rate cutting expectations, and, you know, maybe there is a little bit of a, question marks around that now. But also the AI story, it sort of seems to be remaining intact from the companies we heard from yesterday. So what do you think is going to be the biggest catalyst moving forward now?
So I think there's a different catalyst for different segments of the market. I think in the aggregate, the move toward easier monetary policy starting in the late summer helped small caps again in the aggregate. Yet within the segment that is small caps, there's been a much lower quality bias in terms of what's working, with the non-profitable segment of the Russell 2000 handily outperforming the profitable segment. And that's significant if you just go back to April 8th, kind of the closing low in that first week of turmoil in April. But then more recently, one of the power drivers from a cohort perspective within the market has been retail traders. They actually moved away from those mega cap leadership names. They weren't trading as much in the magnificent area. It had gone into more esoteric micro cap places in the market, quantum, drones, micro cap, non-profitable tech, some of the heavily shorted areas. Only recently did you see some of that attention move back toward those big leadership names. So I think there's multiple drivers of multiple segments. Speculation and rapid fire shift of attention, I think, has been one dominant force. Easier monetary policy has been a dominant force, but maybe the most important one would be, in general, a strong earnings background.
Right, and we've certainly seen that, although to your point, which of course we've discussed many, many times, we are seeing a K-shaped stock market and also economy, and I was speaking to my last guest about that thing, but just want to get your thoughts on, a lack of breadth we're seeing. It hasn't looked good in recent sessions. I'm just looking across some of the sectors today. It's a bit of a mixed picture. What's going to be the catalyst now for a little bit of a more broadening out here?
It's hard to say. It wouldn't surprise me if we maintained a bit of a K-shaped market environment. A couple of days ago, you had the worst breadth in history on an up day. Now, history for that kind of data only goes back to 1990, but it's important nonetheless. I just, retweeted something our colleague Kevin put out about the spread in the last couple of days between the cap-weighted S&P performance and the equal weight S&P performance. outperformance, and there's only been 4 times in history where you've seen it wider than this. They were somewhat uncomfortable reference points, but it's hard to judge what might be a catalyst for sustainable improvement in breadth. I think what's more likely to be the case are these rotations under the surface, where you have index level gains staying relatively healthy, but you have average member changes in terms of industry-based leadership, cap-based leadership. I think that those types of rotations and, bigger drawdowns on an average member basis than you're seeing within the index, I think that kind of backdrop is likely to persist.
Okay, Liz Ann Sonders, thank you so much for your time. Always appreciate your insights. That is Liz Ann, Chief Investment Strategist over at Charles Schwab. Good to see you as well. Appreciate it.